All right. Hello, everyone. All right. This is Peter. Welcome, welcome, welcome to our Tuesday Night Live show here, podcast. And my goal here every Tuesday is to help you demystify commercial real estate and get your first deal done, okay? Or multiple deals. That's the goal here. Always the goal. That's what we're about, okay? Getting results. All right, so let's get started. What I want to do here is if you can put in the chat, I would like to see who's out there. So tell me where you're calling from. I see Ileana from Miami, from Florida. Oh, yeah, Miami. Robert from North Carolina. Donald in Louisiana. I see someone in Three Rivers. All right. Statesboro, South Carolina. I should be there shortly. All right. Sarasota. I will be there shortly too. Mark from Chicago. All right. Rhonda in Ewa Beach, Hawaii. All right. Aloha. All right. Colden from Maryland. I have someone from Newark, California. Leroy from Toronto. Welcome, Leroy. Gail. All right. Perry from Orlando. All right. Keep pouring it in. I'd like to see where you're all from. Anthony from Chicago. All right. Paralethea from North Carolina. Mike from Missouri. Robert from Michigan. All right. We are well represented here. All right. That's awesome. All right. Thank you, everyone. All right. So what I want to do here is get started. I'll let you guys know next week I will be on vacation, but guess what? I'm still going to be here next Tuesday for you. All right. So I'll be on vacation. I have my vacation clothes on, but we're still jumping in here on Tuesday nights. All right. Still. All right. And so the favorite thing I like to do on vacation, of course, is eat, right? And there are 5 families, including mine, coming into one large home together to have a vacation. And I'm looking forward to that. And we usually have one big meal, one big family meal over the course of the 4 days. And my favorite meal to have at that time, I made a request and hopefully they will bring it. But my favorite food of all time, okay, of all time, is gumbo. Okay, seafood gumbo is my favorite. It has crab, shrimp, sausage, chicken, onions, green onions. There's a roux that you make, and then you make a pot. You stir it all up. It takes about 6 hours to make, and then you get a big pot of jasmine rice, and you mix it all in a bowl. It's the most delicious thing in the world, right? I could eat it 7 days out of the week. I am not kidding you, right? I have some frozen in my freezer right now from last year. So I relish it and I save it. So tell me this, put in the chat here while we wait others to come on. What is your favorite food, right? Your favorite recipe. So your go-to meal, put that in here. All right. Donald says he's the gumbo king. All right. He's from New Orleans. All right. And Donald, guess what? I have an uncle named Uncle Dub, and he is from New Orleans. He taught my mom how to make gumbo. All right. A little old Japanese lady making gumbo. It's awesome. All right. Okay. Looks like someone else said gumbo too. So I have Joey says arroz con pollo. Lloyd says ribs. All right, New Orleans. All right, Tamales says shrimp scampi and Caesar salad. Ooh, there you go. All right, Eddie said he loves me some good seafood gumbo. Harvey from Baby Back Ribs. All right, Chandra. Oh, she just joined us. Mirtha says Dominican food. Oh yeah, I love that. When I was there, I love that. Rena says crab cakes from Maryland. All right. That's paella. All right, Jack, that is awesome. That's one of my favorites too. I'm in the heart of the San Francisco Bay Area, and we have the best food here in the world. And the paella here is incredible, right? Incredible. All right, so Rhonda says teriyaki beef and shrimp tempura. All right, Anton is a raw food chef. Very interesting, Anton. All right, Robert says lamb chop, sweet potatoes, and salad. That's exactly what my dad ate almost every day. All right. Phyllis says gumbo is king. There you go. All right. Okay. Cow tongue Benjamin. Really? Okay. Stacy said shrimp Alfredo. All right. Okay. Thanks for sharing. All right. The reason why I share that is every meal that's described here, including my gumbo, there is a recipe for success, right? We have the shrimp, we have the crab, we have the sausage, we have the chicken, we have the root, you have onions, you have bell peppers, right? And you combine it into with rice, and it's the most delicious thing in the world. And the thing is, each one of those things tastes okay, but when you combine everything, that's when the magic happens. Okay, so that's what I'm talking about today. Today, I'm talking about the ultimate wealth formula. When you take bits and pieces of real estate, 10 pieces in fact, and you combine them all together, that's when the magic happens. This is what we teach at our company. I tell you, including myself and all of our students and everybody that I know that are wealthy because of real estate, they participate in this ultimate wealth formula that I'm going to share today. It's the recipe for success, right? And anyone can do it. And it's not made for Wall Street. It's made for Main Street. It's made for us. So we're going to go over it today. Okay. Anyone can do it. And by the end of tonight, you will see that you can do it as well. All right. Okay. So I would like to get started here. All right. Rodrigo says lobster thermidor. Woo. Okay. All right. Oh, Paul says shrimp and grits. All right. Okay. Let me get focused here. Too much food here. I'm getting hungry now. All right. So let's get focused. All right. So what I want to do here is I like to start off with a couple of polls just so I can get the temperature of how we're doing, where you're at and how we're doing tonight. All right. So let me run this poll here. All right. There we go. Here's the first poll. I'm going to run here. All right, here's the first poll. Which statement best describes you right now? Okay, number one, I'm tired of depending only on my W-2. All right. Michael, can you see can you see it there? Okay, yep, I can see. Okay, great. All right. Okay, number two, I have retirement funds, but no clear plan. Number three, I want real estate, but need mentorship. Number four, I want to legally reduce taxes like wealthy investors. And the last one, all the above. So let's see what the answers are here. All right, we have, I want real estate, but need mentoring. That's strong. All right, and it looks like 50% says all the above. All right, let's see, what's the strongest one? The strongest one is I want real estate, but I need mentoring. All right, and that's about 30%. All right, okay, great. And the all the above is at 45%. That's good to know. Good to know. All right, so I'm going to end this poll. Thank you, everyone. I'm going to run a quick second poll. Okay, whoops, here it is. Okay, here's a second poll. All right. Which wealth lever do you think most people overlook? Okay, do they overlook buying off market? Do they overlook seller financing? Do they overlook raising rents? Do they overlook cost segregation? All right, put your answer there if you have an answer. All right, so all of these are wealth levers, and you'll see that they're part of the formula. They're part of the recipe that makes things magical in real estate. All right, so which one do you think most people overlook? All right, so let's see the answer. Seller financing, buying off market is at 37%. Seller financing at 33%. Raising rents at 2%. Okay, yeah, people don't overlook that. That's kind of a, take that for granted. Cost segregation at 20%, but leading the way is buying off market. Okay, so the guest that I have today, that's all he did was buy off market. So you're going to see his strategy and what his results are in just a few minutes. Okay, so you hold tight right there. All right, thank you for that poll. Looks like buying off market is at 41% and seller financing is at 29%. Okay, thank you for participating there. That's awesome. All right, so what I want to do next is share my screen and get this training going. I want to share with you the wealth formula that we use for our students. All right, and okay, one second. And all right, there we go. All right. So can you believe that we are at episode 25? And how many out there, can I take a poll here? How many out there, has anyone been here for all 25? Put it in the chat, right? So how many of these have you attended? Put in the chat. I would like to know. All right, put in the chat. Have you attended 5? Is this your first one? So I have 2. All right, put in the chat how many you have attended. I have 5. Anthony been here 20 times, Michael 23, Raymond 78. Let's see, 1, 7, 10. First one, first time. 1, 3, my third, first time. 7, 5. Okay, thank you so much. Thank you so much. About 5. Roy says, I think 24. All right. Okay, awesome. And Estelle says 10. All right. Donald said this is his first one. All right. Okay, but he does catch the replays. All right. Thank you so much. Thank you for just everyone supporting what we do on Tuesday. This takes a whole crew to put together. We do this for you. And the more participation we get on the chat and the more feedback we get, the more motivated we are to continue these Tuesday night lives. All right. All right. So the ones that have attended this Tuesday night live more than once, are you enjoying yourself? Are these helpful to you? Right? Let me know. Are these helpful to you? The ones that have attended more than once. All right. Yes, absolutely. Yes, 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 they are. All right. Glad to be here. Yes, I love it. Very much so. Okay, awesome. Thank you. Good to hear. Once in a while, the coach needs motivation too. He needs encouragement too once in a while, right? I'm human too, just like you. All right, so thank you, everyone. All right, so we're going to get started with our presentation here. All right, a lot of things to go over. What I'm going to do, I'm going to lay out the wealth formula for you, and then I'm going to bring in our guest who has actually executed the wealth formula, and he is now wealthy. He's now healthier financially, and he is financially free. So he's going to share all this with you of how he used our wealth formula to do what he did. All right. Okay, so we're going to get started. All right, did my quick polls. I'm introducing the ultimate wealth formula. Okay, first of all, since I'm an engineer, I have to tell you what a formula is, right? To kind of set the tone here. A formula is a repeatable set of steps that produces a predictable result. Okay, so whether you have a degree in physics, or you are a psychologist, or you are a truck driver, this is the formula that we all understand to what a formula is. Okay, now for the ultimate wealth formula, it is a repeatable real estate investing process that moves you from retirement uncertainty to retirement control. Okay, so that's the goal today, and we're going to use the process of income, equity, tax strategy, and scaling to achieve that control. Okay, and you'll see very shortly. First thing I want to share with you is hoping is not part of the formula. Okay, it's not part. Stock market, you hope it works. In commercial real estate, we get to control the outcome. Okay, all right. Also, spending your retirement funds is a very risky formula, and there is a better way. So when you spend your retirement funds, right, to live off of, there are 5 problems with that. The first problem is your funds can run out, right? Number 2, if the crash withdrawal, so let's say that it crashes and then you have the withdrawal, you lock in your losses, okay? I don't know how you're gonna recover it if you're older. Number 3, inflation quietly cuts your buying power because your money just sitting there, okay? Robert Kiyosaki always says that savers are losers, and he's so correct, and you'll see that tonight. Number 4, replacing income is harder in retirement, right? Because you're slowing down. You don't make as much as before. And number 5, shrinking balances create stress, okay? A friend of mine who's retired from the state of California has a nice size retirement. And Saturday, we were watching the baseball game at a buddy's house. And he mentioned, as the guys were sitting around, he says that he was happy to say that his retirement dropped 30,000 in 5 years, right? And he thought that was good because he's not doing an investing, he's just withdrawing. And I'm sitting there wondering why is it going down? So why is your net worth shrinking as you get older? Doesn't make any sense to me because I'm a real estate guy. All right. And you'll see that's not something you want to do. Okay. You don't want to have a shrinking balance, creates so much stress. Okay. Next, single family, as you know, is not the formula. Okay. Single family can help you get going, it's a jump start, but commercial and multifamily real estate provide the bigger engine for financial freedom. Okay. You can start with single family, and then the bigger rocket, okay, is multifamily commercial real estate. I love this quote at the bottom of the screen. It says, if you are offered a seat on a rocket ship, don't ask what seat, just get on. Okay, that's what tonight's about. Getting on this rocket ship called multifamily commercial real estate. All right, okay. The formula must have three attributes. It must be affordable, repeatable, and not Wall Street related. Our guest tonight will share with you, he did all three. Okay, and I'm gonna lay it out for you right now. All right, but before I do that, let me do a quick spot check in the chat. All right, if you can just answer the question, my retirement savings / investments are, put in the chat here. Let me see your answer. Are you A, are you running way behind? Are you B, sufficient, but could be better? Or C, I'm starting from scratch. So give me a B, or C. Let's see, I see A's, C's, B's. Okay, I see a good mix. I see A's, okay, B's and C's. Okay, I see a lot of B's. Okay, I see a lot of C's. All right, so it's a very good mix. So you are in the right spot tonight. Okay, here are the 10 steps of the wealth formula. Okay, and I will break down each one. Okay, the first step is to acquire multifamily. Second step is to source off-market opportunities. The third step is to use retirement funds wisely. The fourth step is to structure seller financing, our favorite. Number 5 is to force appreciation. I believe we're the best at it in the world. Number 6 is operate like an owner, and I'll go over the 4 M's and what that means. Number 7 is to become a real estate professional. That is life-changing, ladies and gentlemen, okay? And number 8 is a cost segregation study. I'll break that down, and you'll see the benefits of that. Number 9 is to have multiple exit strategies. I'll tell you why that's the smartest thing you can do when you buy any rental income. And I'm talking houses too, right? But tonight we're not talking about houses. We're talking about multifamily commercial real estate, which is even more important to have multiple exit strategies. And number 10, scaling and choosing your vehicle. All right. A lot of words here. I'm going to break it down. But before I do, our guest, his name is Eric. He put all these pieces together, all of them. Okay. He used stocks and his retirement funds wisely, and he put the pieces together on 3 multifamily deals, about 17 units in a couple of years. And guess what? Look at the bottom row. Eric and his wife, Maria, haven't paid taxes in 3 years. Okay. All right. Who wants to learn how to not pay taxes in 3 years? Put that in the chat. Let's see. Who wants to learn how not to pay taxes in 3 years? Can you imagine having a job and then you can claim 10 and not have to worry about withholding taxes? You can just take all the money you make. That's what Eric is doing. All right. Okay, Ralph. Okay, Robert, I see you. Rose, Canary, right? Canary says, this is what I'm intending. All right, Canary, I am not going to let you down. You will see tonight how it works, okay? RJ says yes. All right, Douglas says yes. Jean, all right. So I'm going to break down each of these steps. It won't take long because I really want to get into the meat with Eric so he can break it down for you how he conducted these 10 steps. All right, step number 1 is to acquire multifamily. All right, start with an asset that can produce income from multiple doors. And you've been here before. I'm a big believer in multifamily. In our company, we probably close probably a good 90% of our deals every month are with multifamily deals. That's how popular it is. There's lots of them. Financing is easier. We can structure seller financing easier. And everyone needs a place to live, right? Everyone needs a place to live, right? So we love multifamily. All right, but let me ask you a question. Okay, here's a chat question. If you could acquire a commercial property within the next 90 days, which would you personally prefer? A, multifamily, B, mobile home park, or C, self-storage? Give me your answer. Put your answer in the chat. All right, so I see some A's. I see a lot of A's. I see a C. I see lots of A's in a C. No one is choosing mobile home park. All right. Oh, someone said industrial, A, B. Christine says they're all great. Derwin says A, B, and C. So does Sheila. Okay. Perry, the same. All right. Okay. Mirtha, B and C. Okay. Great. Great. All right. The reason why I bring up this slide for you, multifamily, mobile home park, and self-storage, is because the ultimate wealth formula that I'm sharing, it applies to all three. Okay. So you don't have to stick to multifamily only. You can also do mobile home park and self-storage. And guess what? Our students have done all three. Okay. All right. Okay. So let's move on here. Thank you for sharing. Okay. Step two. Step two is to source off-market opportunities. And the reason why these are the best deals. Anything that you find on the MLS or online, it's overpriced. It doesn't cash flow, right? And and the wealth formula probably wouldn't work on properties that are online because of that. All right. So you have to get good at sourcing off market, because you can see my quote, beautiful things happen when you have a motivated seller and a motivated buyer. That's you. And it comes together. Again, beautiful things can happen when that happens. Okay. All right. Step number two is to use retirement funds wisely. Let me hit timeout here. Okay. Tonight, I'm talking about using retirement funds. Let me just say this. If you do not have a plan, a good plan that's overlooked by someone more experienced than you, do not, I repeat, do not touch your retirement funds. Don't touch it. Okay. You need a mentor, you need an advisor, you need someone who's been there, done that, somebody with gray hair to help you with your retirement funds. Do not, I repeat, do not try it by yourself. Get help. Got it? All right. Let me put something in chat that you understood what I just said. That's very important to me that you understand this. Okay. Get help if you're going to use retirement funds. Put anything in the chat that you acknowledge this. Okay. Thank you, Eddie, very much. Okay. All right. So let's go number 4. Step 4 of the wealth formula is to structure seller financing. Okay. Our 3 favorite techniques are the master lease agreement, the seller carry first, and the seller carry second. And Stephanie, if you're out there, could you post a video on either one of these on the creative financing for commercial real estate? Put it in the chat. So after this, they can go watch. Okay. Seller financing, learning how to do it is so important, because what you do is you want to leverage your current resources with your new knowledge of creative financing and maximize and leverage yourself into the largest deal or multiple deals. Okay. Just because you have a lump sum of money here doesn't mean you can only do one deal. If you understand seller financing, it can either go to a larger deal or multiple deals if you understand how to do seller financing. I think out there, so far as teaching companies, I believe we are the best. Okay. And we have results to do that. Okay. All right. Step number 5 is a chat question. I want you to finish my quote. Those of you that have been with me for a few shows can finish this. Okay. Finish my quote. The best deals are not just found, they are blank. Tell me. Juanita, thank you. Thank you, my friend. All right. Okay, Abdul, thank you, my friend. The answer is created. Michelle, wow, I am really impressed. That means you guys are listening. Look at Terrence, Beverly, Gail, Mirtha. All right, awesome. Thank you so much. All right, that makes me feel good as a teacher that you guys are getting this. All right, thank you, Willie. All right, okay, great. Okay, so in seller financing, the best deals are created. All right, so what looks like a dud of a deal, we can make it really good if we can apply one of those techniques. Okay. All right. Step number 5, force appreciation. Okay. So you increase the value of the property. You can force the appreciation upward. You can force the property value upward. As you raise the rents, as you raise the NOI, as you control expenses and raise the rents, the NOI goes up, and so does the property value. This is how millionaires and billionaires are made. We do that over time. You're not going to do this in 1 year. It takes 1, 2, 3. It takes a few years in order to do this, but it is life-changing. Okay, life-changing. This is how our students retire, by doing step number 5. Okay, all right. Okay, step number 6 is to operate like an owner, the 4 M's. Okay, you guys have heard me talk about the 4 M's. It's probably the most important thing in our company for our students when they close deals. Okay, when our students close deals, we don't say bye-bye. We work with them on these 4 things that make sure that we maximize the operation of the property, because we split profits with our students. Okay, so we have to make sure they get paid, we get paid, everybody gets paid. And we have systems established for each of the M's: money, management, maintenance, and marketing. The way it goes, if imagine these 4 things are a 4-legged stool. If one of them is missing, the whole thing collapses. Watch this, okay? Out of these 4, let's say the maintenance starts falling apart, right? The maintenance is horrible. Guess what happens when the maintenance drops? The marketing drops, right? Because you're not maintaining well. The marketing drops, the money drops, the whole chair collapses, okay? So that applies to all 4. So you got to have all 4 working, okay? All right. Next is become a real estate professional, okay? Who out there is actually a real estate professional status? Anyone out there know what this means? Real estate professional? Put it in a chat, okay? So Ash does, okay? So only one person knows? Okay, Miss Linda knows? Okay, okay, all right, okay, okay. I was waiting for someone to say no. Okay, so I need to explain this. What a real estate professional is, it's a status that you achieve. I think it's IRS Rule 469 or something like that, right? Where if you can pass this test, if you spend 50% of your time on real estate than anything else, 50% or more of your time on real estate, anything else, that's called the 50% test, right? Plus, you spend 750 hours per year on your real estate business that you own. Okay, I'm not talking real estate agent. You have to own the property, because the third part is called material participation. This is being involved in your real estate. So you can't be like a syndicator and be passive and be a real estate professional. You have to be actively involved. So if you are that, right, if your job is to manage your portfolio, right, not have a W-2 job, 40 hours a week, that's not going to work, then you qualify to be a real estate professional. And guess what? You get unlimited write-offs. Okay, so here's a question for you. A real estate professional can write off, put this answer in the chat, A, inspection costs for a deal that did not close; B, mileage to look at properties never buy; mentoring fees, the costs that we charge you, that you pay us; D, market research before you buy; or E, all the above. All right, so who wants to put in? All right, everyone is selecting E. That's awesome. Yes. So when you're a real estate professional, you write off everything, okay? I write off my pens, right? I write off my microphones. Everything is written off because I'm a real estate professional. If you have a job, right, and you're not a real estate professional, you have limitations of what you can write off. Okay, all right. Okay, thank you for participating in it. Everyone gave me the correct answer. Step number 8 is cost seg study. What a cost seg is, as you know, you can write off the depreciation of a property. Like say a multifamily property, you can write off the building only over 27.5 years. When you perform a cost seg study, you can accelerate the write-off from 27.5 years to, look at this table on the screen, to 20 years, to 15 years, to 20 years, to 5 years. So you can write off things much faster, rather than having every year writing off this much. Every year you can write off this much. Okay, that's what a cost seg does. And because of the one big beautiful bill, we now have a 100% bonus depreciation. That means you can write off everything in the first year. It's amazing, right? So your tax write-offs can go from 20,000 up to 250,000 in 1 year. Okay, we've seen it with our students in 1 year. Okay, with that. So cost seg, get used to that word. All right, now, okay, so someone said only if you're an active and not passive. Okay, that was Raymond. Raymond, guess what? You are incorrect. Look at my next question here. All right. True or false? A cost seg study is only beneficial to real estate professionals. Okay. Put your answer in chat. Is that true or false? True or false? Okay. False, false. All right. False. A lot of false. All right. And okay, a lot of false because I gave it an answer before. That's why. All right. Here's the truth. It's false. Okay. A cost seg can benefit many real estate owners, okay? But real estate professionals often get the biggest immediate benefit because they're able to use the losses more broadly, okay? If you are not a real estate professional, what you can do, you can still do a cost seg, okay? I still recommend you do it because you can still benefit two ways. Number one is you can store up your losses. So let's say you did a cost seg study and you can save $50,000, but because you have a W-2 and you can't use it, you can bank that $50,000 for later. So when you are a real estate professional, boom, you can use it to wipe off your taxes. The second way is when you sell a property and you have profits, you can use those cost seg benefits. All right? Okay. All right. Joe DL is asking, how do you qualify as a real estate professional even though you have a full-time job? Guess what, Joe DL? You can't, right? When you have a full-time job, the IRS sees you as a W-2 worker, not a real estate professional. Okay, so you don't qualify. However, Jovial, if you are married and you start buying real estate, right, you can let your wife become a real estate professional. You can keep your job, and guess what? Combined, you both become a real estate professional and you get unlimited benefits. Okay, one of the benefits of being married. All right, okay. All right, okay, great. Okay, let's go to step 9. You move quick here. All right. Step number 9 is to have multiple exit strategies as part of the wealth formula. Because what if 1 year you can't raise your rents and your plan was to raise the rents and then refinance the property or sell the property? Well, what if you can't do that for whatever reason? Okay. We counsel and coach our students to have multiple exit strategies just in case something happens to the economy, to the interest rates, or something happens, okay? It's just a smart thing to do. Don't get tunnel vision on one thing you want to do. Have multiple exits. That's just smart, okay? All right, okay, let's go to the last one. The last one is step 10 of the wealth formula, and that is scaling. You need, at this point, when you get to 10, you need to choose your vehicle. Path number 1 is to build your own retirement portfolio with your own funds. Path number 2 is real estate syndication. All right. Do we have any people out there that love or want to do syndication? Can you put that in the chat? Let's see who's interested in real estate syndication. Path 1 or path 2? All right. Gail, Wayne, Tamala, Monique, okay, Elijah, George, Perry. Okay, got it. Got it. Okay, both paths. Okay, great. Fantastic. All right, so what I want to do next is I want to bring up our guest. His name is Eric, right? This is Eric's journey. That's his lovely wife to the left there, right? With a great, handsome, beautiful couple there, right? Look at him, just smiling there. All right, a little bit about Eric and his story. Eric did not know commercial real estate investing was available for entry-level folks like himself. He didn't know that. He told us. Eric is also a high-paid professional, right? So Eric has a W-2, but he got the benefit. He got to experience the benefits of a cost seg and Maria being a real estate professional. He'll share his story, okay? He bought 3 multifamily properties using seller financing, no bank, no appraisal, no credit. He cashed out all his stocks and IRAs and bought multifamily. Now, why is that important? Is because Eric is a CPA, right? Eric is a finance guy, a corporate finance guy, really, really smart. And he decided that the stock market and 401ks were not for him, okay? A finance guy decided that to go into real estate. So that says a lot, okay? And now, as I mentioned before, Maria is now the real estate professional. And this is the reason why, one of the reasons why they have not paid taxes in 3 straight years. So you're going to hear the whole story, right? On their first deal, They had a $65,000 tax saving. We're going to put up, oh, we're going to put up their video, their prior video on the screen where he shares how he did that on his first video with us. All right. And so basically, Eric and Maria cashed out some of their stocks and IRAs. They had to pay income taxes and penalties. They did a cost seg and wiped it all out and end up getting a refund. Okay, a refund. Incredible. So without further ado, I'd like to bring up Eric. Eric, are you out there? Introducing Eric. All right, here we
Right.
go. Hello, Eric. All right,
Hey, Peter.
all right, okay. Thank you for joining us today. I really appreciate you taking time.
Thank you very much. Happy to be here.
All right. Okay, everyone, just let you know, prior to coming on today, Eric had a very busy day with getting rents up on his units. Okay. So what he's doing is raising the rents, he's forcing appreciation, he's creating more cash flow because eventually Eric wants to leave his W-2, and he'll tell you why in a second. Okay. So Eric, what I want to do here is you are the model for the ultimate wealth formula. So what I want to do with you is walk through this formula with you. Okay, how does that sound?
Sounds great.
All right, so let's talk about step one. Step one is acquire multifamily. So Eric, let's talk about that. So why multifamily, Eric? Why commercial?
Well, I told you, earlier where, we had looked at several houses. I would say 70 to 75 houses over the course of several months. And we had put offers in on many of those houses, thinking that this was going to be our entry into passive income. And thankfully, none of those offers were accepted, and we never closed on any of those single family homes. But meanwhile, it was during a time I was watching your videos on YouTube, and I said, we ought to look at multifamily, because what you were saying made a lot of sense. Where you have one grass to cut, one driveway to plow snow in, one boiler to repair, one roof to replace, and within that, with that one building, you can have multiple rental units, really driving your income there. So I thought that made a real lot of sense. And on top of that, the scalability of it after you own multifamily, the forced appreciation, all that will go into is really really powerful with multifamily.
Yeah, thank you for sharing that, Eric. So everyone out there, pay very close attention to steps 2 through 10 because Eric is going to lay out this ultimate wealth formula. Okay. And so step number two, Eric, is sourcing off-market opportunities. So this is what we teach. So you're not going to share our methodology, but what's the importance of going off-market? And also, if you can share, one of the benefits is getting closer to seller. So talk about that with us for a second.
Yeah, so really, if you're trying to source properties that are already on the MLS or on CoStar or any of these other big sites, the profits not there. There's no game in those properties. So you have to source off market. And when you do find an off market property, the benefit is the seller knows that they don't have to pay an agent, and they're not going to have to pay a commission on those properties. So the price is already lower, and you're finding owners that understand the game, and that they know they have to sell it at a price that's going to make a meaningful investment for the buyer as well. So really, there's no other way, in my opinion, to buying a property other than off market. I haven't ever found an opportunity on the market that actually pencils out to be anything profitable.
Correct. Let me ask this too, ladies and gentlemen, when Eric used our methodology to locate this owner owned how many properties, Eric?
Six on that block.
This owner has owned 6 properties. So Eric, for the last 4 years, did not have to go anywhere else. He just has to work with this one owner, right? No commission, seller financing, some of it at 4% interest rate that he'll get into. Just amazing. So thanks for sharing that, Eric. Eric, can you share us when you go off market, right? You establish this great relationship with this owner with 6 properties. What was the benefit of just establishing this relationship with the owner? Because yeah, this is a great story.
He didn't actually think we were real. So his daughter, he told his daughter that he got this letter. We reached out to him, and then he didn't believe we were real. So we had to meet him at McDonald's for coffee, and very very slowly we built a relationship with this guy, and he gave it he gave us an offer to he gave us an opportunity to buy one property to feel us out to see if we would actually close. We closed, and then he about a month or two later he called us. He's like, "Are you ready for another one?" And we came back and we negotiated another deal, and then I'd say less than 2-3 months later he called us back and offered to sell us a third property, and we did, and it just really just snowballed. And I wouldn't have found the guy. I would have never met the guy or known the guy if it wouldn't been for Peter's marketing plan.
And Eric, one of the most important things is when you go off market, you get to find out what the seller's motivation is, right? And when
Right.
we know the seller's motivation, we can reverse engineer or structure the deal around the seller's motivation, right? So what was the seller's motivation in this case?
So he owned these properties outright, and his children had no interest in being a landlord. And so really that's how they saw property ownership, as having to be a landlord, having to go and replace boilers or hot water heaters, or carpeting and all that. And really that's not what I was going in as. I was going in as an investor. And but his kids had no interest in buying his properties, and he had owned them outright. So his motivation in selling them was, one, he was getting older and his kids didn't want to take over. And two, he wanted to make sure that he didn't get hit with a huge capital gains tax bill. So he wanted to make sure that he could finance us, and then spread out his tax bill over several years. So that
Yeah,
was
yeah.
his major conditions, which worked in both of our favors.
That's great. Okay, which brings us to step 3, which is to use retirement funds wisely. And I bring this up because, Eric, you are a corporate finance guy, brilliant finance. You have you're a CPA, and most CPAs are very, very conservative, and the average person thinks it's taboo to touch your retirement, your 401k, right? Your stocks, don't sell them, right? Buy and hold, don't touch. But you, Eric, did not. So talk us through that. What was that your mindset there?
Well, I don't want to work until I'm 65 years old, or 59 and a half, I guess, if you would be the earliest I would be able to withdraw my funds. My dream would be to exit much earlier than that, and time is money, and I can use that money now to build a passive income portfolio where I don't have to wait till I'm 59 and a half or 65 to actually start to draw on all of my life savings. So the way I crunch the numbers, and with Peter's assistance and strategy building, that I was able to see that I could take the funds out safely by a strong passive income wealth building opportunity that would give me immediate benefits as well as capital appreciation, long term benefits as well. And to be honest, my portfolio has performed better than anything in my 401k has since I've bought these properties.
That's great. That's great. Eric, your wife Maria said something that I wrote down. It's powerful. She says IRAs and 401ks are designed to profit Wall Street and not Main Street, which is us. So, what did that statement mean to you and Maria personally?
Well, there's a lot of hidden fees in these. So, I mean, you may look at a fund and say it may show on paper that it's producing, 10, 12% annual returns. But when you actually get it, there's a lot of fund management fees and all these other fees that come on top of it that are actually, deducted from your portfolio. So you don't have that. And if you own the building, or if if you're buying multifamily, I mean, you are your own fund manager. You are controlling your own destiny, and if you can control your own expenses and increase the rents to where they need to be, really you can in force appreciation. You can really drive your own, and you can drive your own future with real estate, especially commercial real estate, as opposed to letting Wall Street deliver you the ups and downs.
Absolutely. Absolutely. Okay. And it brings us to the fun stuff here. Step 4, which is structure seller financing. And you and Maria did this really, really well. You were able to get a 4% interest rate. I don't know how in the world you did that. But folks here in the audience want to know a little bit about the structure. So talk to us about the structure, right? And also too, we can back this up by knowing his motivation. So how did this all come together?
So he knew that in order for him to finance us under his terms, because he did not want a lump sum payment, he knew that he'd have to offer some favorable rate. So in order for him to get what he wanted, which was really a structured payout over several years, that meant he would have to give us a rate that would be even more competitive than what a bank would give us. Because why would I take his rate, which, if he wants to make a couple extra percent more than the bank, I could just go to the bank and get it, and then he's not going to get the deal that he wants. So I mean, it was a win-win situation. He got the structured payout for his mortgage payment over several years, reducing his capital gains. And I got a favorable rate, which I think in the end both parties won.
That's great. That's great. So how did you get the 4% though? That's tough
So I think at
because
the time the rate was about 5.5, 5.75, and I think he had offered maybe 5, and I came back and said, well, I can get my own bank rate around 5, and so he came back with 4, and we settled that. I was happy with that, to get the 4% rate, and we just moved forward, and he didn't seem to have any problem with that rate either. So, and
okay,
the rates
great.
actually, after I made that deal, the rates had went up significantly over the course of the next couple of years. So the next deal, the next 2 deals, I think we settled at 5%, which was still, I think rates were over 6% at that time. So
Yeah,
he was able to get an extra percent on that.
that's great. Someone's probably wondering how long is your seller financing structure for? How many years did he give you?
It is a 30-year amortization, meaning like the payments are structured as if it's a 30-year loan, but the balloon payment is due at year 10.
Okay, so 10-year deal, 10-year deal. Okay, great, great. Okay, everyone out there, we are at step 4. Are you starting to see how this wealth formula is kind of coming together, right? And it's kind of easy to follow, right? And I want you to put into the chat if you have any questions, and I'll do my best to get them answered by Eric. Okay, so we're going to move on to step number 5, Eric, and that was forcing the appreciation, raising rents. And when you and I talked today, you got on and you said you were busy today raising rents. So you mentioned to me that when you bought the property, his properties, the rents were 50%, 50 below market.
50% below market. Yeah.
Wow.
I would
Okay.
say between 40 to 50%. Some of them, yeah, depending on how long the tenant was there. He never would raise rent.
Wow. Wow. And why don't you think he raised rents?
He was older, and I would say, pushing 70s, maybe early 70s, and he was an owner operator. Not nothing was under management, and he did not want to go in there if someone moved out to go paint the place, put in new flooring, update the kitchen or the bathroom. So it was easier for him. He owned the buildings outright, and he was happy with the money that he was making. That he didn't want to deal with the headaches. So it was better for him to have people just never leave.
Yeah, that's great. That's great. Okay. All right. Thanks for that. Oh, one last question on this on raising the rents. You're 50% below market. Weren't you concerned about people moving out as you raise the rents?
Yes, and well, in the beginning, I mean, obviously, you don't want everybody to leave it in mass. So we took it gradual. We did, I think, like maybe 12 to 15% the first year, and then another maybe 15 to 20% the next year, and then this is like the final push this year is another, I would say another 12 to 15%. And now we're at market with this last rental raise. And some of the people left in the beginning, a few people, and then maybe a few people the next year, and then a few more this year. And getting a turn on your rental base is not a problem. You just don't want everybody to leave at once. So I was happy with the way that we did it, taking 12 to 15 rather than just assuming a 50% raise all at once and then everybody would leave. So I actually had pretty consistent renters. Couple people left, and that's okay. It's okay to have turnover, in my opinion,
Yeah,
in commercial real estate.
that's true. Okay, step 6 is operate like an owner, the 4 M's, right? So everyone, Eric is managing 17 or more units, just he and his wife, right? So Maria is handling the management of the property, the 4 M's. Is that right?
Correct. And we also have a management company,
Okay,
so
so
and that
management
really helps.
company and Maria gets to oversee the management company.
Correct.
Hmm. And you get to work on the rents.
Yeah, well, together, Maria and I, we handle the money side. We review the rents and the books every month. We look at the books, see how we're doing. Actually, we put together like a budget and a plan, how we're tracking the budget and plan, and seeing where our expenses, what buildings are tracking higher, lower, things like that.
Okay,
Yes.
okay, great. Lynn has a question. She says, did you have to do any rehab, Eric?
Yes. Yes. Lots of rehab. In the beginning, when the rents are 50% below market and you're not buying the building 50% below market, the it gets a little it was a little tight in the beginning when we first bought the buildings because there was turnover, people were moving out, and so it was a family experience. My sons, myself, my wife going in there, ripping out bathrooms, kitchens, painting. So I would work a full day at the W-2 job and then put on my tool belt and then go work a full night at the apartments. And I did that for about 7 months. But now the buildings are stabilized, they're under management, and now I'm able to have buildings renovated by a maintenance team and other teams, and I get to really just provide the money side of things, and it's a much better experience now than the first. But there is a little sweat equity when I entered the space.
Sure, sure. I have Odell asking, so I'm guessing these properties were not in a rent stabilization ordinance area. That's true, Odell. That wouldn't happen in this case. All right, let's move to step number 7 is become a real estate professional, right? And Eric, in this case, you still have your W-2 job, and then Maria became the real estate professional. Because of that, as a couple, you guys get all the benefits tax-wise of being a real estate professional. Is that correct?
That's right.
All right. And how has that worked out for you?
So it's been great. All of our real estate losses that are really due to depreciation write-offs are all offset against ordinary income, and ordinary income being W-2 wages or 401k distributions, or wherever you're getting ordinary income, your passive income can offset that if you have real estate professional status. So it's a game changer when you enter this space.
All right, everyone, you heard that game changer coming from a CPA, coming from a corporate finance guy. Okay. Step number 8 is the cost seg study. I talked about what that is, but Eric, talk about what the benefits were for you and Maria doing a cost seg study. Let's go back to your first property, if you don't mind.
Sure. So I mean, I recall when I was actually on phone calls with you in your mentorship program, I had mentioned that we had a pool of money that we had potentially had access to, but I was afraid of the tax consequences. So you had brought up the cost seg study. And as I looked into it, I did my own research, and I said that this really could be something here. But what they do is they break up the components of your building into different years. So, you could have a 27 and a half year property, which could be the bricks, the roof could be 10, the ceiling fans and electric could be 7. There's 5-year property, which might be like your carpeting. And the company does a study of all the components of your building, and then they break it down into those categories. They layer in what the land value is, and then they say, okay, here's what your depreciation schedule is according to these different cost segregations. And then from there, then you can look at what is the bonus depreciation. And right now, as you mentioned earlier, with the big beautiful bill, it's 100% bonus depreciation. So you don't have to actually depreciate over 5, 7, 10 years. You could depreciate immediately in year one, all of that upfront, which is very powerful, especially if you're using retirement funds and you have your real estate professional status.
And thank you for that. So, Eric, you had a situation where you had a tax bill of several hundred of thousands of dollars, right?
Right.
And you did a cost seg, and it completely wiped it out. And you went to the on the other side and actually got a refund.
So it not only wiped out all of the ordinary income from the withdrawal of the IRA, it also wiped out my W-2 wages. And the only payment I had to make to the IRS was for the penalty, the 10% penalty on the withdrawal, which was covered, by my W-2 tax withholding. So I ended up getting a refund, even though I had a penalty. The taxes taken out of my paycheck more than covered that penalty, and so I ended up getting a refund and a tax loss carry forward into future years, which I still continue to use today.
Wow, great. I hope everyone out there is just listening to this. This is the ultimate wealth formula in action right here. Okay, let's go number 9. Step number 9 is to have multiple exit strategies. So, Eric, you have the 3 properties, 17 units that you bought under us. What are the exit strategies? Is it a long-term hold? Are you going to put a long-term loan on them? Are you going to sell them later? What's your exit strategy here?
I mean, it's hard to say at this point exactly what I want to do. Ideally, I'd like to do a cash out refi and keep the buildings for generational wealth and really have like an infinite investment in the buildings. Really, no skin in the game. That would be the ultimate. However, if I get the right asking price on the building, I would consider selling it as well. But there are multiple exit strategies in front of me right now. There the one that I'm looking at, long term, I would love to do a cash out refi and keep the buildings and just continue to keep those in the family.
That's awesome. That's awesome. Okay, let's go to step 10. This is scaling. And here, you wanted to scale by going into syndications. Is that right?
That's right.
Okay, great, great. So everyone, you can see where Eric is headed, right? So this is the ultimate wealth formula right here. All of this works leading to Eric going into syndication. I think Eric's looking for, you said minimum of 70 units. Is that next?
Yeah, 70 to 100 units.
Yep. There you go. There, and then leaving your job, right?
That would be that would be the end game. Yes.
All right. Okay. So Eric, I have a last question for you. And Eric, if we were to compare the old Eric, right, financially to the Eric today, what are the differences in income, security, options, and peace of mind?
I mean, really, this has been a financial freedom exercise. And do you want financial freedom, or do you want to be beholden to your employers keeping you around for that job? You never know when that employer may come to you and say your job's been outsourced, or we've decided to move to a different location, or you sell this department. You never know. But with passive income, you have a safety net, and not only could it be a safety net, but it could be a general wealth building opportunity. So I highly recommend going into commercial real estate, and specifically, for me, a multifamily worked very well.
And Eric, how has this changed you in terms of peace of mind about your retirement and your financial future for you and your family?
I would say at this point, I'm already making an equal amount from the buildings that I am from my W-2. I'm just not ready to quit the W-2 yet. With the properties under management, I could still continue to earn dual income, and I'd like to scale up more before I decided to jump into real estate full time.
Awesome. Awesome. All right. All right. So everyone, you just experienced what the ultimate wealth formula is. And I have one question for everybody out there, right? And listen up, here's the question. Who wants to be like Eric? Right? Who wants to do what Eric is doing right now, like tonight, like next week, right? You can see he did this on small multifamily. He didn't have to buy a $10 million property to get to where he is today financially. Didn't have to do that, right? He got mentored, right? He followed the system, and look at the results. Look at the results. So I'm going to bring up this poll right here. And the poll is going to be this, right? And here's the launch, right? Who wants to learn more about what we do with our students? We have what we call a done with you mentoring program. We do this with you, and we work with you until you make a $500,000 profit, right? And then we work with you all the way into that point. So it's a done with you program. If we make no money, you make no money. If you make no money, we make no money. So our interests are mutually aligned. So this is why we work so hard to make sure our students are successful. This is why I talk about the 4 M's, right? The money, the marketing, the maintenance, the management, all that comes into play to make money in commercial real estate. Very important. So if you'd like to learn more, go ahead and click yes, or you can click yes, but I have some questions. Go ahead and click that. All right, okay. This is a done with you program. I'm going to end the poll here. I have a second poll I'd like to run. And that second poll is, who would like to speak with someone tonight? Okay, so we have people on standby tonight that you can speak to tonight, and they're available. All you have to put here is select now, and then we will reach out to you. All right, again, it is a done with you mentoring program. We're with you every step of the way, holding your hands. And Eric, how was our hand holding with you?
It was great. There was, a few calls a week that if you had any questions, everybody was there to answer your questions, and reviewing the deal status and just making sure that you weren't entering into a bad deal, and that everything was reviewed by people who have done this time and time again. And I would have been very worried without the support of someone from a mentorship, and I think that you guys did a great job, getting us into this marketplace.
Thank you. Thank you. Okay. All right. Go ahead and enter that. Okay. I'm going to end the poll here. What I want to do next is show you something here on my screen. Give me a second here. I want to share this here. Let me go to share. One last thing. And I want to share this with you all. Right. And basically, if you can go to commercialpropertyadvisors.com, commercialpropertyadvisors.com schedule right here, right? It's going to take you to this screen and learn more about doing deals with Peter, right? You're going to go to your state, select your state. So I'm in California. You click on schedule my call. Okay, so let's say you want to speak with someone tomorrow, Wednesday, and you select your time, let's say 9 o'clock. Okay, you click next, then you put in your information here, and you click schedule event, and voila, you are off and running. Okay, and you can schedule something just like that. All right, okay, all right. And let me share with you one last thing here, and this is for anyone who was late to the party here. All right. And there's anyone out there who would like to speak with someone tonight and learn more. Okay. So speak with someone tonight and learn more. Go ahead and if you missed the party a minute ago, there you go. Go ahead and click that, and we'll have someone reach out to you. We have people on standby. Okay. And again, it's about recreating what Eric did with the ultimate wealth formula. Okay. You can see what Eric did. It made total sense. And if Eric can do it, you can do it as well. All right. Okay. I'm going to end the poll there. All right. And I'm going to stop the screen share. All right. And everyone, do me a favor. Go ahead and give Eric some love. Tell him thank you for his sharing tonight. It was amazing. It's amazing. He sounds like he's a 20-year pro. That's what he sounds like. All right. All right, so everyone go ahead and just tell Eric thank you. Put it in the chat. Just say thank you, Eric. High five to Eric. Yeah, Eric, the chat's blowing up. They say excellent. Thank you for sharing. Thank you so much. Thank you. Thank you. Thank you, Eric. So fabulous. Congrats. Congratulations. Very nicely done. We are proud of you. Eric, your tax setup, game changer. All right. Eddie says, good job. All right. Tony says, gracias. All right. Sheila says, two thumbs up. Jean says, thank you for your teaching to Eric. All right. All right. Okay, great. Great. Okay, thank you for sharing. All right, everyone. So, Eric, I just want to again say thank you so much. This has been fantastic. Thank you for sharing your story. And give my love to Maria. And you guys are doing awesome. And just, thank you so much.
Yeah, thanks for having me. Much appreciated.
You're welcome. You're welcome. Okay, everyone, just hold on a second here. What we're going to do, we're going to segue into a video that I want you to watch. So that video is going to start in about 5 seconds.